DCC, which is in the FTSE 100, but more importantly is also in the BritBox, because I put it there, is a company that we haven't talked about yet. It's got a market cap of 5.2 billion. So here's what this thing's doing in at least our BritBox. I actually got it from the same place that I found the Cord Energy thing, but not in at the same time. Particularly, a guy called Conor Maguire over at Value Sits. If you're watching this on YouTube, market cap of 5.2 billion, and with a name like DCC, it could be doing frankly anything. What it actually does is three things at the moment. It has an energy division, and it has a healthcare division, and it has a tech division, at least as they call it, technology. More on that shortly, but 5.2 billion then in market cap. Operating income, energy generates 515. I put 515 quid. I meant 515 million in operating income. Healthcare generates 75 million, tech around the same. So the vast majority of this comes from the energy business. And what does that energy business do? It's an independent distributor. So it supplies liquefied petroleum gas, it invests in renewables projects, it owns and operates fuel stations, it distributes petrol, diesel, other fuels, often in kind of remote, less well-connected areas. Based in Ireland, by the way, the company, but operates in more than one country. That part of the business, the energy division, has been growing quite nicely, growing at around 7% per year. And you might well think that this is worth the kind of multiple for the entire thing by itself if it didn't have these god-awful healthcare and tech arms attached to it, which, by the way, are not growing. They're stagnant at best and going backwards at worst here. So the healthcare part of the business distributes medical products. It manufactures health and beauty products, and it's worth, well, we'll see what it's worth shortly, but it makes about 75 million in operating income. Technology is it's another distributor of electronics stuff, basically. Doesn't seem much techie about it to me, other than it's a load of electrics. And that's a similar profit level thing. So here's the reason for being interested in this stock now. They are a bit like Dowlais, who I talked about before several weeks ago now, planning on doing some divesting. They're planning on divesting this healthcare business and this technology business. And I think that's a good thing, because I think this is a case where the energy business by itself might arguably be worth the entire damn thing. Unlike Dowlais, DCC's balance sheet is pretty well intact. They don't have more debt than market cap. They're not underwater. They have a pretty good credit rating, and their plan for their divestitures, when they get round to selling off these things to focus on their energy business, is to return it all via dividends. So what might you get back? Well, here's what the analysts seem to think. They value the healthcare business at 1.3 billion, which is quite a lot for something that is making 75 million in operating income. And we might have to call up the guys who bought Dowlais's hydrogen business, see if they're interested in taking this off our hands. But in fairness to DCC, and I think they are right about this, it's the kind of business that they've struggled to get enough scale into to make it genuinely profitable. It's the kind of thing that could be worth a lot more to someone who has an infrastructure that they can plug this kind of business into. I'm not sure exactly who I think that is, but that multiple doesn't seem to be as crazy when you think that they could pull quite a bit out of this and there's some good stuff underneath it. Tech business worth about 800 million, so just over 10 times operating income. That doesn't sound crazy to me at all for what is a fairly basic electronics distribution business here. So that gets you to around 2.1 billion. Then if you think that's coming back as a dividend, that's about 40% of your market cap and investment coming back to you in cash. The question is, having sold off that much of your business, are you about to see the share price drop by 40%? Because since we're not dividend investors on this show, we don't think that's a very good investment. You get 40% back in cash and the share price goes down by half. Passive income, blah, blah, blah. That's not really the way we think about this stuff. But my answer is probably no here. So if you're left with the energy business, it's growing at about 7% per year, which is decent by most standards. And at 515 times operating incomes, you're looking at sort of just over 10 times that, making up the current market cap. And if you're not underwater with debt for the time being, I don't think that's kind of crazy. Around 10 times operating earnings for something growing at 7%, they think is their kind of best part of their business. I think this is the right strategy. So clear out this other stuff that is currently distracting and taking up time and capital and so on. If you can raise 2.1 billion for this and give me 40% of my cash back, well, then I'll take a view on the energy business afterwards. I might still think it's worth it at these prices, but if not, if the share price holds anywhere near where it currently is, be happy to get out of it. There are some risks here, but my plan is to wait for divestitures and see what's left afterwards. So, a bit like your Axum thing, Steve, I'm kind of wait and see what happens with a short-term thing for an unusual reason.
It's this. It's strange, really, because they couldn't be any more different companies. But the sort of plan is roughly a wait and see what happens kind of plan for them, isn't it? It's yeah, I made the mistake of opening a few trading statements to try and get a feel for the business, and they are some of the worst trading statements I've ever come across in my life. It says group adjusted operating profit for the third quarter ended 31st of December 2024 was broadly in line with the prior year and modestly ahead of the prior year on a constant currency basis. No numbers. You just have to try and decide what broadly in line and modestly ahead it kind of means to you. So, not a great font of information. In fact, if we were to complain about anything, Steve, the standard of UK disclosure is pretty bad for these trading updates. But look, this is again. I said to you off air, Steve, I didn't have a clue what this company did. For whatever reason, when you told me you were picking DCC for the BritBox, I thought it was some kind of publishing company for some reason, and I just thought you're going to have an angle on this. I'll trust you on the angle of this publishing company. I don't really understand why we're doing this, but but to my surprise, it's a completely different company, and perhaps one, with a serious investment case underneath it that I need to take more of a look at. I was surprised by those revenue numbers. It's a big company, Steve. It's a much bigger company than I give it credit for. I don't know how I could have looked at those revenue numbers and figured out it was a publishing company, or a marketing company or whatever. But yeah, it looks interesting, Steve. I think you've put a really interesting case forward there, and it'll be interesting to see what they do with these businesses, these non-core. Well, I guess they are core businesses, but I guess they're trying to say the non-core businesses going forward. Yeah, I'll be interested to see. Is this something you have shares in at the moment, or is this
It
something you're
is.
thinking about buying?
I do have shares in this. I didn't just dump this in the BritBox without buying it myself, or at least having plans to buy it myself. I can't remember which order they happened in. That's the last time you trust me to recommend stuff for our random collaborative projects here. I do own this. I mean, there's an obvious way in which this goes wrong, and it went wrong for me on Dowlays, kind of. I made it out of Dowlays and I've sold it since fairly happily, fairly well up. But none of the up was to do with the reason that I actually wanted to buy the thing, which is that they were attempting to spin off a division. Because the deal they got instead of spinning their division, or the deal that's currently being put to shareholder vote, is terrible from what I can make of it. And the share price has actually made its way back to roughly where it was before the pop off the news, which is actually quite a bit higher than I bought the thing. I'm roughly flat on DCC at the moment. But in the case of Dowlays, I made a good return on that, but not because of the thing that I was expecting to happen, because the share price just started working higher, probably with the worst of the news in, which I could have sort of predicted, but it wasn't really the kind of main reason I was interested in this. DCC is in a much stronger position, full stop. It's not underwater with debt. It doesn't have huge amounts of restructuring costs. It hasn't just been spun out of something with more liabilities that the kind of parent company didn't want, basically. But nonetheless, it's UK-sided stuff does struggle to attract very good term deals for this. I mean, in Dowlays, you saw a company smaller than it, in a worse position than it, having to bung cash into it so that when they merged, they could own more of the entire business. Which was mad, as far as I could tell. But there are no guarantees when it comes to these kind of things. You may or may not get anything much of any value back from DCC. But I think in this case, even if they just took away part of the debt for this, it would leave the energy business in not a terrible position. I'd need to think a bit more carefully about energy distribution, which is their market, to think whether this was something I really wanted to own on that basis. But I think for the time being, there's probably enough margin of safety if they can get anything like what the analysts value this at. I mean, those analysts putting the numbers there, they may or may not know anything, to be honest, but it makes it hard for anybody to pay much more than this, and it makes it hard for DCC to accept anything much less, I think, because one way or another, someone's going to point to those things and say, hey, hang on, you said they were worth this, or some people think they're worth this. We can't be seen to be massively overpaying, and you can't be seen to be massively under achieving on it. So we will see, and I will watch with interest. And yeah, that final trading update, I went to bed the night before that thinking, this is going to be great. There's going to be some sort of news about a takeover thing, or at least some sort of news about something good. And there was absolutely nothing for me to write about in that. I had to try and turn that into an article somehow, and I attempted to expand it. And I ended up kind of rehashing my investment thesis on it, which has nearly nothing to do with the way it's trading right now. But there we are. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.